Kami masih terhubung dengan Thomas Hayes, Chairman and Managing Member, Great Hill Capital, langsung dari New York. Hi, Thomas.
Hi, Eileen.
So we would like to continue about as the dollar decline. So you mentioned it before, it's getting more interesting for U.S. investors to invest in emerging markets. And which markets and which asset class that you find is, attractive at this moment?
Yeah, I think the knee-jerk reaction for a lot of managers is when they see the dollar decline, they want to rush into gold. And what we look at historically, Warren Buffett actually put out a statement in 2018. He said, if in 1942, that was the first year he ever invested in stocks, if you put $10,000 in gold or $10,000 in the S&P 500 in stocks, by 2018, you would have $400,000 from the gold investment or $51 million if you had invested in the stock market index. So basically, by investing in gold over the long term, you would have lost about $50 million of gains that you could have had in the stock market. So I think as people look at a weakening dollar, and down the road, the Fed has committed to letting the economy run hot. They've targeted 2% symmetric inflation, which means they're going to allow the economy to run over 2% inflation for the amount of time that it ran under 2% inflation. I think that in the short term, people shouldn't be distracted by running into gold, because over the long term, the companies will retain their pricing power to help with that inflation expectation moving forward. And over the long term, over many decades, you're going to do much better in stocks.
Okay, so I would like to discuss about Asian market with the Shinzo Abe stepped down from his position as the prime minister, and then also Warren Buffett put his investment in stock market in Asia. What can this region offer to investors, in your opinion?
Yeah, I think this is a very positive thing. Markets are expecting no major change in Japanese policy. The Chief Cabinet Secretary, Yoshihide Suga, is the frontrunner for the position. And since Abe came to power, it's become much more shareholder friendly. So for some time, foreign investors were afraid of putting money in Japan because the companies were controlled by the families. The profit margins were very small. They didn't pay out a lot to shareholders. And under Shinzo Abe's reign, basically what's happened is the EPS, earnings per share, have gone up. The profits as a percentage of sales in the last 5 years have gone from 2 to 4% historically to over 5% per year. And so long as they keep this type of policy in place where shareholders have a say, the companies are doing the right thing for all stakeholders, I think you're going to see continued flow back into Japan. And you're starting to see that from Warren Buffett, one of the greatest investors of all time, with a $6.2 billion investment with the top 5 trading companies. I think that says a couple of things. Number one, I think he sees potentially Japan coming back as a major exporter and maybe taking a little bit of the business that China is losing. And two, based on the companies that he's invested in, it has a little bit to say about commodity demand moving forward and emerging market growth. So I think all of those things point to positive things for the region moving forward. And that policy will remain in place, which will be a good thing for Japan and will be a great thing for Asia.
And for you, do you think that the U.S. market right now is very expensive, as what Warren Buffett think? And then will his footsteps will be followed by other big money in the U.S.?
Yeah, I think it's really a tale of two markets. So on the one hand, you have the tech stocks like the FANG and Microsoft that have probably gotten a little bit ahead of themselves, like the Teslas, et cetera. And on the other hand, you have all of the cyclical and value companies that are trading at very low valuations. So why is no one investing in the banks, in the industrials, in the defense stocks, in the energy stocks that have been left behind. I think the core catalyst that's going to change and shift. Number one, I think people are becoming aware that some of the tech companies are overvalued. But two, I think the vaccine is really going to be the catalyst, because that's when all the demand is going to come back, and that's when you're going to start to see high earnings growth rates. So historically, the cyclical stocks outperform coming out in the early stages of a recession when you have high economic growth. And we're just coming out, we're certainly seeing in the economic numbers, in the Citibank Economic Surprise Index, it's trading at an all-time high. That measures the percentage of data that's coming in better than estimates. It's never been this many beats in economic data. So, moving forward, I think you're going to see a shift from the high valuation stocks into the lower valuation stocks as the growth starts to kick in. And that's really what's happening here. Right now, when people expect slow growth, when everyone's at home, they have to bid up those few stocks that afford growth, which are tech stocks, which can do well even if people stay home. Once people go back to normal and that economic growth cycle kicks in, every single recession recovery is led by cyclicals, banks, industrials, et cetera, certainly for the first 12 to 24 months. And I think we're going to start to see that rotation in the next couple of months for sure.
So as the US market has recovered from the pandemic, do you expect, even like some indexes has reached all-time high, do you expect there will be major correction in the near future?
I think in certain sectors, as I said, this is an election year, so September and October are usually better than normal. So even if you had a flat to slightly down general indices in the next couple of months, I do think you could start to see some rallies underneath the surface of the stock market. So even if the indices only go up a little bit or come in a little bit, there will be sectors that start to perform, like financials, like industrials, like defense stocks that have been left behind. They'll start to go up even as tech maybe cools for a little bit and takes a breather moving forward, because they have, in some sense, gotten ahead of themselves relative to earnings expectations. If you look at Apple itself, the highest current year earnings multiple ever prior to this period was 26 times current year earnings. Right now, it's trading at about 39 times current year earnings. So it's 61% higher multiple than ever historically. So you either have to bet that they're going to do twice as well as analysts expect, or it's a little bit overheated in the short term. So I expect some of the big tech stocks to maybe take a breather in the coming months into the election, and some of these other sectors start to participate. But for the general market, maybe it goes sideways, maybe it consolidates a little bit, maybe it pulls back a little bit, but there's tremendous amount of opportunity underneath the surface, Aline.
Okay, but the uptrend will keep intact. Okay, thank you very much, Thomas Hayes, for joining us, Chairman and Managing Member of Great Hill Capital from New York. Informasi tadi sekaligus menjadi penutup closing bell hari ini. Terima kasih Anda sudah bersama kami. Terus saksikan CNBC Indonesia di cnbcindonesia.com, Transvision Channel 805, dan Anda juga bisa menyaksikan CNBC Indonesia melalui UCTV di IndiHome. Saya Alin Wiratmaja, jaga kesehatan Anda dan keluarga. CNBC Indonesia, Beyond Business.